For us. Let's dig into the broader market as stocks pull back just a bit from the record highs. Samana joins us now, Wells Fargo Investment Institute Senior Global Market Strategist. Samir, good morning. You know, it was 3 months ago today that the S&P made its intraday low. We're up 30% since then. That was the moment of peak uncertainty. A lot of that uncertainty has evaporated now. Some more confidence in the outlook for the second half. How does that set the market up to you?
Yeah, I mean, look, we unfortunately find ourselves back at close to fair value. You know, our year-end target is 6,000 before the tariffs kind of came into play. We were at 6,500. Maybe the truth is somewhere in between. But I think it'd be fair to say that you're at fair value. And so you start to kind of have that conversation around, you know, all right, we're at fair value. Do we overshoot fair value? And, you know, I think at least with the momentum, given some of the moving averages, given some of the technicals, there's the possibility that we could overshoot. But at least from our standpoint, look, there's still some risks out there, right? I mean, once you kind of get past some of these issues, you still have a problem with, you know, rates that are still, you know, a little high on the shorter end for markets, right? Even the Fed will say they're a little tight. On the long end, they're starting to kind of climb back up. So I do think you'll have some pressure, at least from a valuation standpoint. And then from an earnings standpoint, we still don't know how that's going to impact, you know, how tariffs will impact earnings. And I've got to think that they probably at some point have a, you know, an impact to lower them from where we started the year. So when you take all that into account, probably not a bad time to take some profits. But at the same time, I will acknowledge that the trend is higher.
Yeah, I mean, all those things you mentioned, I think, can be maybe looked at from the separate angle. Okay, rates are a little bit restrictive. Well, that probably means we're in the window of a Fed rate cut within the next few months, especially if things start to soften up in the economy. And then when it comes to earnings, I wonder how you think the bar is or how much it's been lowered for second quarter results. It feels as if those estimates have really come in quite a bit.
Yeah, no, you're spot on, right? I mean, I think the top line is supposed to come in at about 3%, you know, growth, and the bottom line is supposed to be 4%. I mean, that compares to like 7 and 15 last quarter. So clearly much lower expectations for this quarter relative to the last quarter. But again, you know, we know the dance, right? We've got really low bars. A lot of the companies will beat. But I think the real key will be, you know, look, how much demand deterioration are you seeing if you're passing tariff prices along? Or are you eating the tariffs, in which case your profit margins are coming down? So I think that's the tricky part, is the real question now becomes who's paying the tariffs?
How long do you think it'll take for us to really get an answer to that question, Samir, especially now that, you know, we're looking a few more weeks out for potentially a bit more clarity on that front?
Yeah, I mean, look, I think that's the tricky part, right? Is first you have to set the tariff rates, and then you've got to figure out, you know, kind of who's going to pay them. So it wouldn't surprise us if that's, you know, maybe a question that's answered sometime probably in 2026. Now, look, markets aren't going to wait until 2026, right? They're going to kind of probably run with kind of what their best guess is. And I think there's some early inklings that it could be some of the, you know, exporters outside the U.S. that are paying them, at least initially, which I think the market's taking as a positive.
So does that lead you to any kind of call on international exposure, Samir?
So really the dollar is kind of the key, and with it pretty oversold now, it could be that the administration is happy to see it oversold. Maybe they want to see it even lower. We do think that there's this sense out there that it's a universal trade, a pretty crowded trade. So at this point, we would still favor the U.S. over international. If the dollar were to rally, let's say somewhere into that 105, 107 level on the Dixie, I think we would at least consider developed markets. Emerging markets are probably a little bit of a different animal, but I think developed markets could make some sense as maybe kind of a second-tier choice after the U.S.
I know that you feel as if it's still kind of prudent to stick with higher quality parts of the U.S. market. That has actually been a very successful way of approaching things because it has included enough of the big cap kind of AI exposure. Are you paying up too much for quality right now? Is there an opportunity cost there? Or you feel as if that's still a good trade-off?
You know, we think it's still a good trade-off because, I mean, look, the tricky part is, and I look at the Russell 2000, which is small caps, you know, that's a small cap index, and I mean, that trades at 27, 28 times. Now, someone would push back and say, well, look, a lot of those companies don't make any money. To which I would respond, yeah, that's why we want to stay away from them, is they're not making any money in what I would consider an otherwise good environment. So I still think you've got to focus on profitability. And look, I don't like multiples where they are here, right around 24 times. But considering the fact that rates on the long end especially are still, you know, well behaved, I think you can still take kind of the risk on the you know, higher quality, higher growth areas of the market.
Yeah, we'll see, you know, how we define well-behaved if we go up another 30 basis points on the 10s. It feels like it's a pretty sensitive dial there, Samir. Thank you very much. Appreciate it this morning.
Thank you.